Welcome back, and thank you so much for joining us. As you know, many homeowners have worked for several decades just to pay off their home, but now they only find themselves in the crosshairs of a potential or pending foreclosure. Brooklyn resident Fillmore Brown faces foreclosure on the home that he purchased in 1996. And this is according to a recent story we found on Realtor.com. It's quite unsettling, so let's dive into it. So he's at risk of losing his home because he has a $20,000 debt from an unpaid water bill that began just as a $600 outstanding balance. We'll get into how that balance grew so quickly. But that minor oversight has spiraled into what could be a financial catastrophe for him under New York City's existing lien system. So property and water bills can be packaged and then sold to a private trust or a group of investors. And once it's in their hands, they're free to basically foreclose at some point in the future. The column notes that many believe that only mortgage holders are at risk of foreclosure, but as we already know, there are technical foreclosure proceedings which can be done when one does not have their property taxes paid or their homeowner's insurance premiums paid up to date. But in this situation, we're looking at a utility bill, and it's a sobering reality, they say. Even homeowners who have fully paid off their home are not immune from losing everything. But here's the cruel twist of irony. The same year that he made his final mortgage payment, that's 2019, he had a $600 water bill that kind of slipped through the cracks, and it began to accrue interest at a staggering 18% per day, according to his attorney, Alice Nicholson. Now, 18% a day, I don't even know loan sharks that charge that, but maybe they meant a year. Nevertheless, the debt ballooned up to $5,000 with that accruing interest, and then the city added their fees and penalties, which totaled another $15,000, and that pushed his total outstanding bill to $20,000. So that's when the city did place a lien on his property and sold it to a private trust. One of the issues is that the overdue bill had to have shown up on the earlier statements, but they did claim that it disappeared later on after it had been sold to the trust or to the investors. And he kept paying thousands of dollars in current taxes and water charges over those years. The Department of Finance does claim that Mr. Brown was properly notified. They have constructive receipt as he was served papers, but was he? He claims he never saw those papers, and he lives on the top floor, but he rents out the lower units below him, and he insists I never got those papers. So in New York City, they do have the right to sell a lien for unpaid utility bills to an investment trust, and those charges have to have been delinquent for at least 1 year or more for that to happen. And the same is true for property taxes. Realtor.com notes that the trust purchased the debt for about 70 cents on the dollar, and then they work with debt collectors to try to recover the balance. And if they can't do that, then they can also pursue foreclosure proceedings. But in practice, lien holders do gain the power to push for foreclosure if debts remain unpaid. That means a relatively small balance, which began as $600, remember, can snowball into a debt big enough, $20,000, to cost the homeowner their property, and I think this is criminal. According to Bloomberg Tax, there are 18,000 properties at risk of lien or foreclosure sales for unpaid utilities or even taxes, and with an average balance of about $30,000. That was in 2025, and sadly, 40%, a very significant portion of those, are located in Brooklyn and Queens, and 70%, 7 out of 10, were in a majority non-white neighborhood. So we're seeing kind of a bifurcation as to the type of individuals that can really be stung by these foreclosures. One missed bill, one lost home. That really is a harsh reminder of the fact that older Americans that have their home paid off can still find themselves facing foreclosure due to unseen circumstances. In Mr. Brown's case, that was a lien for an unpaid utility bill. So as a reverse mortgage professional, you certainly want to educate homeowners about their property charge obligations or even utility payments. So I did a little research, and here are the states that actually can initiate liens for seriously delinquent utility payments. And those are Iowa and Kansas. Quite interesting. And here are the cities that I found that can place a lien for unpaid utilities. Those include Washington, D.C., Chino Valley, Arizona, Murray, Kentucky, Sinclair, Wyoming, and Akron, Colorado. Homeowners in those areas should be educated, if you're working with anyone in those cities, on the importance of paying utility bills in a timely manner.
Every month here, we want to look at case number assignments. So unfortunately, in June, they didn't quite go the way that we had hoped, but in May, they had also dropped. They actually dropped by over 10% to 3,020 case number assignments. In June here, the biggest culprit most likely was that rise in the 10-year CMT in May, which is probably really what drove this number down. Equity takeout lost 8.6%. H for P was also down by 10.6%. And HECM to HECM, which I didn't put on here correctly, but the HECM to HECM refis, they're down by 21.5%. So all across the board, every segment were down. It wasn't one certain segment or not. However, in June, the 10-year CMT did see an improvement, so we'll see how that helped lift some of the endorsement numbers here. But real quick, kind of talking about that CMT, just kind of looking, see what the monthly trend has been. And again, this is just monthly. It obviously tracks differently, all in all. But here we just want to show you that in May, that kind of larger spike, and then it dropped down in June, and it's kind of been relatively flat. Kind of been dropping still into July and August here. So we've actually still continued to see a little bit of a decline. Nothing too drastic, but we'll see how those declines and the kind of like downward trend helps as we continue to go into the year here. As far as July endorsements, they grew 5.6% from June to 2,369 loans. This was actually the highest level since February, so that's a positive. Again, most likely that's attributed to interest rates, the CMT interest rates. But the regions were mostly stronger. 7 of the 10 were increasing. Midwest added 19.8% to 194 loans. New England was up also at 19.8%, identically for a percentage, but only up 109 loans. Southwest Caribbean gained 12.1% to 536 loans. So all in all, across the board, the different regions did pretty well. The lenders were slightly worse, but not horrible. Down, 6 of them were up, on the month. Guild jumped 43% to 86 loans. TMAC was up 33% to 117 loans, and South River was also up by 12.5% to 63 loans. So with another month of endorsements around that mid 2000 mark behind us, and the 10-year CMT continuing to slowly push lower, what can we expect from August? Will the rates be enough to keep things moving in a positive direction, or will the summer month reverse course and as people finish up their vacations? I don't know. Tune in next month to find out. Thanks. Have a great one.
Housing Wire's Reverse Mortgage Daily reports that more older Americans are open to reforms when it comes to local zoning laws to help ease the strain of housing inventory and to also make housing a little bit more affordable. And what could that mean for reverse mortgages? We'll dive into that. And also in aging in place, I'm going to talk a little bit about the cost of aging in place in your own home, I should say, versus going into a facility. So let's take a quick look. 2 recent surveys from AARP and the Pew Charitable Trust reveal that an overwhelming percentage of older Americans do, in fact, want to age in place, but their homes are often unsuited to that purpose. And of course, rising home prices and a shortage of housing inventory is going to make it difficult for them to relocate. In fact, an AARP survey found that 73% of those 50 and older did say they wanted to stay in their local communities and age there where they have social connections, local amenities, and access to services. And of course, they've built relationships with local medical care providers. The survey also revealed that among older Americans, it is a priority to find a community that has an adequate number of age-appropriate homes that are affordable to older adults. And I don't know where those communities are right now, maybe in the Midwest. Pew's survey found that most older adults support having a more simplified and faster permitting process, and also allowing for commercial spaces to be converted into housing and for apartments to be near transit and job centers. So here are some interesting results from those surveys. And while you're looking at that, I just want to talk about the cost of aging in place. Now, desiring to age in place is one thing, but achieving it is quite another. It requires really balancing one's accessibility needs with their own economic realities. And with more choosing to stay put or pulling their homes off the market, which we are covering also today in our Monday edition of the Industry Leader Update, the house could be one of the few tools that would allow an older homeowner to really make those needed modifications. But by guiding clients on how they can responsibly use a reverse mortgage for modifications and structuring the loan that way, you can really help them safely remain in their home while preserving their equity. So let's talk about the financial realities of aging in place. First, renovations. To make a home suitable for aging in place can range anywhere from $20,000 to $100,000. And while that is significant, it actually pales in comparison to other options, such as $21,000 a year for in-home care, or $54,000 a year for assisted living, and over $100,000 for nursing home care. Having a conversation with potential reverse mortgage borrowers about their plans to age in place, I believe, is not only appropriate but prudent as to what sort of changes they think their home would need, what those renovations may actually cost, and how they plan to finance them. Do they have another source of funds to accomplish those goals, or would they be looking to tap into their housing wealth to get that done?